Hello everyone, here we will discuss accounting process and principle. This chapter will tell you in detail about accounting cycle, various characteristics of accounting, limitations of accounting, the differences between accounting and bookkeeping, various users of accounting, and in detail and last we will discuss accounting principles and conventions. So first we will take what is the meaning of accounting. Accounting is concerned with the qualification and interpretation of past and prospective economic transactions. In fact, accounting helps in preparing the financial statement of any business, which are the fundamental source of financial informations. Accounting can rightly be termed as the language of business also, because through this only you can obtain or you can inform to the various users of accounting about the results of business, either profit status or loss status, information about asset or various liabilities. Above all, accounting is a base of financial management decisions. This is very right statement which has been discussed by everybody, that accounting is a tool for management for taking financial planning in future, because through it you can obtain information about profit or losses. You can take a true picture of your business by the way of balance sheet. Now if suppose we will take the definition of accounting on behalf of American Institute of Certified Public Accountant. Accounting is an art of recording, classifying and summarizing in a significant manner and in terms of money, transaction and event which are a part of financial character and interpreting the result thereon. This is very true and interesting definition which is given by American Institute. They are saying that accounting is an art of recording, classifying and summarizing. These three are basic characteristics of accounting. Here we first record the transaction, then we classify the transaction, and finally we summarize the transaction in the format of trading account, P&L account and balance sheet. But remember always, these three activities we do always with those transactions which can be recorded in money only. And after these three activities we also interpret the transaction in accounting. Accounting characteristics we will take now. First is, accounting is a language of business. This is very true point we can understand. Accounting is a language because through accounting you can read the business activity, through accounting you can write the business activities, and through accounting you can understand the business transactions. So therefore we can just deem it as like a language of business. Secondly, this is a service activity because it provides some functions of quantitative information of financial performance to the users of accounting. Quantitative information stand, they are providing the informations about profit or losses and wealth of the organization. So they are quantitative informations. So any users who are interested to obtain these informations, they can obtain it through accounting. Now, what are the objectives of accounting? One is systematic recording of transactions. Accounting is only way by which you can systematically record the transactions. As I said in the last slide, recording, classifying and summarizing are three important activities of accounting. So from these three activities you can systematically record all the business transaction in accounting. Second is, through accounting process you can obtain financial informations very efficiently. Like if you are preparing trading account, you can obtain the information about gross profit. If you are preparing profit and loss account, you can get the information about net profit, and from the balance sheet you will have the information of your net wealth. Third one is, these reports you can obtain very quickly. If you have prepared the results, if you have prepared the journal entries, ledger, trial balance and in last final accounts, so you can obtain the informations very quickly through accounting. Next is, to ensure a high degree of accuracy. If I have done all the activities in accounting, so there is no doubt that accuracy will be 100% in accounting. Otherwise, if it is not there, then there is a chance of rectification of error in the accounting. Next one is accounting tell you about the financial position of your business. If on any stage you would like to know about your financial position, about the status of profit or loss, or the status of your asset and obligation, you can obtain straight away from accounting process. Accounting provide informations to various users regarding their financial decisions for future. Like if an investor is willing to know that what is running in the business, he can obtain the information from accounting. If any creditors, government, society, promoters, anyone is suppose they are willing, so they can obtain informations from accounting, and then they will be able to take it for future planning. Next is, if you would like to know the solvency position of your business, your liquidity status, how much cash you are carrying with you, what are your current liquidity obligations. So these all informations correctly you can obtain from accounting itself. Now let's come on the next slide for accounting cycle. First stage of accounting cycle is analyzing the transaction. First we always do the analyzing stage, because first we used to know that is there transaction available which can be recorded in money, they will be entered only in the accounting. So this stage is known as analyzing stage. And the second stage we do the journalizing of the entries. After identifying the transactions, then we start journalizing it. And in the third stage, after journalizing the transaction, we do recording of those transactions in the ledger known as posting. Next stage is summarizing stage known as preparation of trial balance. And in the last stage, we prepare the financial statements known as trading or profit and loss account and the balance sheet. So these are 6 stages which we always carry in accounting cycle. First, we always analyze the transaction. Then we do on behalf of chronological system and the journal known as recording. Then we transfer them in the ledger known as posting. Then we prepare the trial balance to check the accuracy of journal and ledger known as summarizing. And finally, we prepare the financial statements after doing the closing entries. So these are the cycle. This is the cycle of accounting process. Now, what are various functions of accounting? First is recording. This is the basic function of accounting. It ensures that all business transactions of a financial characters are correctly recorded in the chronological order. The recording is done in the book, which is popularly known as journal. So in the recording process, we always try to do the recording on behalf of chronological system. For an example, if suppose on January 1st you purchased the goods, on January 3rd you sold the goods. So in chronological system, first you will do the transaction of January 1st, then you will record the transactions of January 3rd. So these recording you do in the book of journal. And the second stage, we actually do the classification. After putting all the transaction on behalf of chronological system in journal, we do systematically transferring the data in the book of ledger. For example, if suppose in a 1 month you purchase 10 times, so all 10 transactions will collectively come in a single account known as purchase account. So these activities we do in the ledger and known as classification. Third stage which we are carrying is summarizing. So after putting the same transaction in a single account, we do the summarizing of the transactions. All the transactions we carry in a single account known as trial balance to just check the activities of accuracy and the recording or classification known as summarizing. So these are 3 basic activities known as the functions of accounting also: recording, classification and summarizing. Recording popularly known as journal also, and classification popularly known as ledger also, and the last stage of summarizing known as preparation of trial balance itself. Next stage is various branches of accounting. In accounting generally we carry 2 branches. One is financial accounting and next one is management accounting. Financial accounting is the branch which informs about the financial results. It will tell you about the information of profit or loss. It will tell you about the picture of your balance sheet, which will carry asset and the liabilities. So these information you can just obtain for all kind of users, either they are internal users, either they are external users. But the second branch of accounting, known as management accounting, they provide the informations to only internal users like promoters or management or administrators. Basic difference between financial accounting and management accounting is financial accounting provide the results of your performance, but management accounting do the interpretation of those results. Like if suppose are you carrying profit or loss, this you will obtain from financial accounting. But why we are getting less profit or why we are getting high profit, if you would like to know the interpretation, you must have to go with management accounting branch. And the other difference is that management accounting only helps to the internal users for future planning. So these are two branches of accounting. Next is we need to understand various limitations of accounting. A common man presumes that an income statement shows a correct income or loss of the business enterprises, and a balance sheet portrays a perfectly true and fair picture of financial standing of an enterprises. But it must be recognized that accounting is a language and they are carrying some own limitations. So now we will discuss some limitations. As we all know, accounting is a language. It provides you the information of business, but it doesn't mean that from accounting you can obtain always a true and fair and perfect picture of your business. Accounting itself carrying some limitations. So what are that? First is different accounting policies for treatment of same item add to the probability of manipulation through various laws or various accounting standards. In accounting, we are carrying different methods, different policies for same transactions. For example, if I would like to cut depreciation on any fixed asset, suppose, so there are a lot of methods. There are a method of straight line method, there is a method of reducing balance method. So what method you are going to choose, it will reflect your profit or it will reflect your financial position. A financial statements only consider those assets which can be expressed only in money. The factors which may be relevant in assessing the worth of the enterprises don't find place in the accounts if we can't measure them in the money. This is very true limitations of accounting. As I said from the first definition slide of accounting, that only we record those transactions which can be just recorded, which can be taken in the money and the accounting itself. So this is the biggest limitation of accounting. Those items which cannot be recorded in money will be not part of accounting itself. For example, we can't record the loyalty of any employee and the balance sheet, because loyalty you cannot record in the money. So this is the biggest limitation of accounting. Next is balance sheet shows the position of the business on the day when you prepare the balance sheet. Balance sheet doesn't tell you anything about future expectation, and shareholders, investors, creditors and most of the users are always willing to know about future status of the business, but balance sheet only tell you about the past informations. What you have done in the last year, balance sheet will tell you on the 31st March that picture. Next is certain accounting estimation depend on personal judgment of the accountant. For example, if I would like to know about the status of provision for doubtful debts, so it depends on the accountant what method he is going to choose to calculate PBD. So sometime it depend on variation and the calculation of financial results. Same thing happen if suppose you are going to calculate your closing stock, if you are going to know that this expenditure is capital expenditure or revenue expenditure, mostly and like it depends on the personal judgment of accountant. So it reflects the financial position of your business. So this is a limitation of accounting. So basically we can understand the major limitation is balance sheet shows the past position and non-monetary item you are not recording in accounting. These are the two biggest limitation of accounting itself. Now we will take in discussion the differences between bookkeeping and accounting. Bookkeeping is a process always concerned with the recording of transaction only, But accounting process deal with the summarizing of transaction, as well as accounting will tell you in detail about the financial results. So bookkeeping is only a single part where you only record the transactions on chronological system. But apart from it, in accounting, you classify the transactions, you summarize the transaction, and as well as you interpret the transactions in management accounting itself. Second point is bookkeeping is a base for accounting, but accounting deemed as well as a language for business. As I said from first point, in bookkeeping only you record the transactions, but in accounting you record the transaction and as well as you inform in detail about the financial position of business. Because therefore we say that accounting is a language. Third is bookkeeping has no subfield, but we all know that in accounting we are carrying lot of fields. Financial accounting, management accounting is very non-subfields of the accounting. Financial position of the business cannot be calculated from accounting or bookkeeping. The true answer is from bookkeeping you cannot obtain the financial position exactly, but from accounting you can obtain perfect and true financial position of your business. From the record of bookkeeping, managerial decisions cannot be taken, but from accounting you can obtain the future planning as well as the managerial decisions, because bookkeeping doesn't tell you the detailed financial positions, because only you record the transactions over there. But in accounting you record and you do the interpretation as well as, so it will tell you the detailed results which will help you for managerial decision itself. Now we will discuss what kind of information we obtain from accounting. Basically there are two kind of information, one is non-quantitative and one is quantitative informations from accounting. In case of quantitative informations there are two types, one is purely accounting information, one is non-accounting informations. So there are two heads for information, one is where you obtain quantity, one where is you obtain non-quantitative information. And in case of quantity, you know, one is non-accounting and one is accounting. So in case of accounting you can obtain three type of information: what exactly kind of operation you are operating, you can obtain informations; what business you are doing and how much profit or losses you are obtaining from a business, this you can obtain from financial accounting; and what kind of decision making you will use, this will tell you by management accounting. So this structure will tell you in detail about structures of various informations. Now who are the users of accounting? Basically we can take owners, management, creditors, government, and employees as well as society or public are the major users of the accounting. Owners are those who have invested the fund in the business and started the concern, so they are always willing to know what exactly business is doing. Management is the part of business who are operating the business, so they are also willing to know the efforts of themselves. Creditors are those who have actually given the funds to the business, so they are willing to know that when they will get back their funds, so they are always willing particular for the liquidity status of the business. So all these informations creditor can obtain from accounting. Government, employees, society, public are also the different types of users, because we are living in a society, so they are also interested part of the society who are willing to know what exactly business is doing. So financial accounting will help you to all those users about the status of profit or loss, about the status of asset or liabilities. Now the next part of this chapter is accounting principles. Accounting principles can be subdivided into two categories. One is accounting concepts and one is accounting conventions. Always remember student, if you would like to know, if you would like to talk about any time for principle you can divide in two types. One you can take concepts and second is conventions. The term concept is used to indicate the necessary assumptions and conditions upon which accounting is based. Concepts simply stand that what kind of indications, what kind of assumptions we carry in accounting. And convention is used to signify various customs and traditions which we can use as a guide to presentation of accounting statements. So concepts are assumptions or basis, and convention are customs and traditions to prepare or present the financial results. First, we will take various types of accounting concept. We are carrying here business entity concept, money measurement concept, cost concept, going concern concept, dual aspect concept, realization concept, and accounting period concepts. So these are 7 points which we will discuss one by one as accounting concept, which is an essential part of accounting principles. First is, and in case of accounting conventions, only 3 conventions we are carrying. First one is convention of consistency, and one is consistency, and next is convention of disclosure, and last one is convention of conservatism. First we will take one by one various concepts. First is business entity concept. Business is always treated as a separate entity or a separate unit from owners or businessman. For example, Reliance Industry Limited is separate from Ambani Group. Ambani Groups are the owner of the Reliance Industry Limited, but when you will see the balance sheet or financial statement of business, that is not for Ambani family, that is actually for Reliance Industry Limited. So all the transactions of the business we record in the book of business from the point of view of the business as an entity, and even the owner is treated there as creditor to the extent of their invested capital. This is very true point. We do all recording the transaction in the book of business, not in the book of owners, and we treat owner as a creditor because they have invested some capital at the starting of the business. Next concept which we are carrying is money measurement concept. In accounting, we record only those transactions which are expressed in the term of money only. We cannot take those items which are not part of monetary activities in the accounting, as well as this is a limitation of accounting itself. But the fact is that only those transactions which can be taken in volume of money and accountancy. This is due to money measurement concepts. Next is cost concept. Transactions are entered in the book of accounts at the amount actually involved. This is very true concept, and accounting always prepare on the cost, and cost means the amount which was actually involved at the time of acquisition of asset. For example, if a company purchases a car for rupees 1,50,000, but the real value of car was rupees 2 lakh, but we will record in books the value of car rupees 1,50,000 only. So the cost of acquisition known as concept of cost. This is one of the most important concept, and from this concept only you can obtain the true picture of profit or loss. If suppose in the previous example, if we will sell the car for rupees 2,20,000, so it will tell you that you are going to obtain rupees 70,000 profit, because already you paid 1,50,000 for that car, and now you are getting rupees 2,20,000. Next is going concern concept. This concept assumes that business will exist for a long time and transactions are recorded for this point of view. We always assume in accounting that accounting will continue in the future also, and we also presume business will go long in the future for 1 year, 2 year, 10 year even. So we presume that accounting will consistently perform for the business. Next is dual aspect concept. Each transaction has two aspects, that is the receiving benefit by one party and the giving benefit by the another party. For example, if one person is purchasing car, so he is paying the funds to the next party. So he is paying the funds is the benefit for the next party, and the car is the benefit to the first party. So every transaction carry at least two benefits. This principle is the core base of accountancy, always remember. For example, if there is a purchase of rupees 10,000 cash in business, then two accounts will come. One is purchase account and next one is the cash account. If suppose you are going to buy some goods and you are paying 10 lakh rupees, it means you are getting goods and you are paying 10 lakh rupees. So two accounts will simultaneously affected. Thus, the dual aspect can be expressed like asset are equivalent to capital plus liability and capital is equivalent to asset minus liabilities. Always remember, your capital means your net wealth and net wealth is a difference between your asset and liabilities. So these are two equations which you can understand always in the dual aspect concept, only due to because all transactions carrying minimum two accounts at least with them. Next is realization concept. Accounting is a historical record of transactions. It records what has happened. It does not anticipate events. This is a great important in preventing business firm from inflating their profits by recording sales and income that are likely to be occur in the business. So due to realization concept, you can just get to know what will you get the profit after some time and what will be the status of your balance sheet due to realization concept only. Next is accounting period concept. In accounting, always financial result of a period we can obtain, and this period would be a year, 6 monthly, quarterly, or for 1 month itself. It depends on the purpose of your business. This time interval is called as accounting period concept. Next is we will take in discussion various accounting conventions. Already we have discussed 7 accounting concepts. As I said earlier that we will divide principles in two parts, concepts and conventions. Now we will take in discussion accounting convention. First is convention of consistency. In order to enable the management to draw important conclusions regarding the working of company over a few years, it is essential that accounting practices and methods remain unchanged from one accounting period to another. Always remember student, if I would like to make a comparison between your current year and previous year of your financial position, then it is only possible in that case when you are carrying the same policies, when you are following consistency rule for both the years. The comparison of one accounting period with another is only possible when the convention of consistency you are actually following. So always remember, if suppose in last year you have taken one method for depreciation, so same method if you have to take the next year, then you will having the right to make a comparison between the financial positions of the year. Otherwise there will be some errors because it will reflect of the financial position of both the years alternatively. Next is convention of disclosure. This principle implies that accounts must be honestly prepared and all material informations must be disclosed thereon. This is the major duty of any business houses. If suppose they are preparing their results, so they have to disclose all material facts of business. They don't have to hide anything in the businesses. Then the true purpose of accounting can be obtained, because accounting is a language. So if you are not recording anything in accounting, accounting will never tell you the true picture of your business. The content of balance sheet and profit and loss account are prescribed by law. So as per Company Law Act, you have to prepare of your profit and loss account and the balance sheet, and there is a provision that you have to disclose all the material facts. You cannot hide anything. These are designed to make disclosure of all material facts compulsory. Next is convention of conservatism. Financial statements are always drawn upon a base of restriction, and that is we always make some provisions particular for future contingencies. If suppose we are feeling that in next year tax rate will go increase, so we'll make a provision for taxation to transfer some part of your current profit for payment of that taxes in future. So this is due to convention of conservatism. Thank you very much.